Okay, good morning, ladies and gentlemen, and welcome to the second day of this great conference. This morning, we have a traditional fireside chat. So we started with the fireside chat for today, looking into the issues of mobilizing finance for the private sector in a geopolitically fragmented world. It's a continuation of the discussions we had yesterday, except that today we are just, for this particular fireside session, we are focusing on the mobilization of finance for the private sector. And I'm delighted to introduce to you a panel, both here and then online, who will be joining me in the discussion. And for those who are not here yesterday, I should start by introducing myself. Victor Morende. I'm Executive Director of the African Economic Research Consortium, which I joined from SOAS University of London. And I'm glad to have a distinguished group of people for this fireside chat. Let me start on my extreme left with the Professor Robert Lenzing, who is a distinguished economist, celebrated economist, as you say, honored economist, and a professor of financial markets and economics at the University of Groningen. As a long CV, I could spend a whole day explaining his great work, but he's a global figure, and name recognition person, and we have grown all together. That's possibly the best way of introducing him. He's made a lot of contribution in this particular area, and he will be weighing in, drawing from his vast research over the last decades. We also have Dr. Marcelo Carvalho, sitting next to me here. He's a global macroeconomist with more than 3 decades of experience as top financial institutions, including the International Monetary Fund, JB Morgan Stanley, BNP Paribas, and he served as the managing director and the global head of economics at BNP Paribas. He holds a PhD in economics from the University of Illinois and has led international teams of economists across Americas, Europe, and Asia. And he joins us indeed now as an independent speaker who is able to introduce some even controversial. And I would like to encourage you to do that, by the way, in the discussion as we go ahead. Now, we are joined online by Ama Latte. And Ama, it's great to see you here, given the work that we started with Riser. Ama is doing a lot of innovations, especially linking research and innovation, and a large project called Research and Innovation Systems for Africa, RISA program, funded by the UK FCDO to support innovation and research system strengthening across Africa, including Ghana, Nigeria, Kenya, Rwanda, and South Africa, a project that she's working very closely with Dr. Meng Xie, who's been here in this program. Ama, we welcome you here to participate in this, to draw in particular from your current experience of how innovation and research systems can work together as an ecosystem, and to weigh in on some of the questions that we shall be dealing with. So we have this distinguished panel, fireside chat, among 4 people to be able to explore and go into the issues of mobilizing finance for the private sector in a geopolitically fragmented world. Let me kick off by recognizing the fact that what is different, say, for the last, say, 10 years, is the recognition across the developing world and emerging markets that the private sector is the engine of growth. That if you want to explain the key differences in growth patterns across the world, the viability and resilience of the private sector is important. The question that arises then is, how do we finance the private sector? What are the key aspects of financing the private sector that we think might be threatened by this shift in geopolitical, financially connected systems? What is it that we need to focus on? But maybe before I go this, I need to highlight a couple of things. First, to give you a snapshot of the current conditions globally across the world in financial markets. In financial markets, we find the key influencers, for example, GDP growth has been stabilizing globally at about 3% per annum. If you benchmark that across Africa, in Africa it's a little bit higher, about 4%. Now, if you look at the main financial markets, take as economists the key financial prices, namely interest rates and exchange rates, and the connection between interest rate and the exchange rates, covered interest parity conditions for those who are in that space. We find that interest rates, right from COVID, interest rates started going up. There's a ratchet effect of interest going up. This basically to manage the liquidity, but also to manage exchange rate depreciations. Now that inflation has stabilized, interest rates are going down, but in terms of the policy interest rates, that's the policy rate, the one set by the central banks. It doesn't follow necessarily that when the central banks set the policy rate, that the commercial rates will go down. There is a huge difference. And what is becoming difficult is the downward rigidity, the inflexibility of commercial interest rates to go down, those between the commercial banks and households at companies. This is relevant because we are talking about private sector financing. And the financing that even when the policy rates by central banks go down, the response in terms of lending to commercial companies is not happening. That is in domestic financial markets, in domestic credit markets. What about globally? Globally also, the interest rates are not going down. And so if you look, say, the difference between the domestic interest rate and the foreign interest rate, okay, that parity is where the covered and uncovered interest parity conditions come in. You realize that interest rates, especially the access by sovereign countries in the developing world, especially in Africa, to international capital markets is very difficult. It's very difficult because the rates are still high. And for companies based in developing world, their access to global capital markets also is done as very high. Why? Because of the risk premium. The lending rate for companies for the private sector is based on a formula that is anchored here in London, the London Interbank Offered Rate, RIBOR. And this is determined as the interbank, the cost of lending to companies is, say, if it is, say, call it 15%, is equal to LIBOR plus a markup. LIBOR fluctuates all the time. It's the markup that speaks up the risk sensitivity that is a problem. So in terms of the global scenario, then of course, access to by companies to global capital markets because the problem, because of high risk and the risk rating agencies come in, are perceived high risk premiums that are associated with the access to capital markets. Now, but we should be looking at this in this fireside chat also in terms of various aspects of finance and whether the private sector could play an important role, for example, in helping countries to make the sustainable development goals, 17 of them. If you look at the performance of the SDGs today, you will find that, for example, continents like Africa score lowest, except in only 3 dimensions. Only 3 dimensions. The rest of the dimension is scoring lowest. So the role of the private sector may be contributing to growth, but in terms of the targets of SDGs, and for Africa, the 2063 agenda, that is very far from being achieved. And we want to see how we can re-engineer the financing, the private sector, that can help the developing world to come closer to the aspirations, not only in terms of SDGs, but also in terms of the vision of Africa 2063, the Africa we want. Okay. So in this conversation, I'll call upon the members of this Fireside Chat to come and weigh in on key particular issues. Let me say, in terms of, say, for example, financing, microfinancing, financing of small, medium enterprises, the role of microfinance institutions, and also the domestic credit markets. So let me first invite Professor Robert Lensing to come in. I did introduce him earlier, but let me say over time, and I can't think of many more people that have contributed to this literature more than Robert on the role of microfinance institutions in supporting private sector growth. Robert, you have the floor.
Thank you very much, Chair. It's a pleasure to be here, to be invited for this panel. And to be honest, I was in first instance a bit surprised that we discuss microfinance institutions given the topic of today, because what you see with microfinance institutions, they traditionally use kind of debt contracts which are not so kind of stimulating investments. If you look at standard microfinance debt contracts, they have a typical structure which very often are similar to consumer contracts in the Western world. So they typically have short grace periods, small amount of credit, frequent repayments, etc. So they're all not so, let's say, what we think of if you really want to stimulate medium-sized enterprises or even bigger companies, then you need to have bigger loan sizes, not short grace periods, not so frequent repayment periods. So I think that if you want to give microfinance institutions a bigger role in stimulating private sector and private sector development, then it's very important that microfinance institutions start with more flexible contracts. So contracts which kind of induce firms to take more risky investment, contracts which allow for bigger loan sizes, which allow for less frequent repayments. Yeah, so I think that there is quite some literature on this as well. So people are arguing that microfinance, the contribution of microfinance may increase quite a bit if they step aside from the traditional microfinance debt contract. Of course, there's a problem because there was a reason why they were focusing on those standard contracts. It was very much because of the default issues. So there is an issue which you need to deal with. I think so the first thing which I think is important for microfinance institutions, they need to think about more flexible contracts, which are more conducive for the private sector development. The second thing is, and that is what you see happening already, is that microfinance institutions more and more stepping aside from only debt contracts. And so traditionally, microfinance was very much associated with credit only, but other financial products coming in and are maybe even more important. Savings possibilities, of course, but also insurance possibilities. It's very often still kind of micro insurance, but you see that happening. So I think that there is a specific role for microfinance institutions as well. And another thing which I think is quite important, and there is some literature on this, is that microfinance institutions sometimes serve as a kind of a delegated monitor for commercial banks. So for instance, there was a big program a project in Rwanda where they subsidized microfinance institutions. And what you saw happening is those microfinance institutions shared their knowledge about the borrowers with a credit bureau, which could be picked up by commercial banks. So you see that those kind of promising firms were kind of screened by the microfinance institution. They got the possibility to start borrowing from commercial banks later. So there's a kind of a bridge. So that, and I think that microfinance institutions may play an important role in this sense, being a bridge, kind of a delegated screen or monitor for maybe commercial banks. We'll leave it by this for a moment.
Thank you very much, Robert, and especially bringing in the role of microfinance, but also linking up with the rest of the financial sector, especially in emerging economies. And the key aspect of your argument is, of course, the mobilization of resources. Even when we perceive large companies, especially large financial institutions, the experience, for example, in Africa has that we have now a new class of banks called Pan-African banks. Okay, these banks started as microfinance institutions, especially in Kenya, in Nigeria, and in Morocco. And now they are Pan-African, actually outcompeting some of the global conglomerates that used to be the main banks around the 1980s. So there is a way transition of the microfinance to the large banks. Why do they actually able to grow so rapidly and go across border? Because the environment has changed, but most importantly, they argue that they understand the market much better than the global conglomerates. But one of the CEO gives me a different argument. Said, why is it that you have been able to cut across a number of African countries and still outcompete more of the banks? And his answer was passion. Passion is the passion in financing growth, especially through the company sector, that drives him to be able to achieve that, that goal. Your conversation is to think, and now I would like to turn to Amalate online. You have great ambitions, great aspirations. The last time we talked, you had this aspiration of raising $1 billion, $1 billion for impact investing, for investing in Ghana and West Africa in that front. So I'd like you to share this dream, these aspirations with the audience here, and the great work you are doing in impact investing in Ghana as the CEO, and especially explaining to us the whole idea of impact investing and what exactly you are doing. Very inspirational. So, Amma, you have the floor.
I hope you can all hear me. Yes, and it's a great pleasure to join this fireside chat. And it was interesting hearing the reflections about microfinance and the need for more patient capital that can motivate firms to take on more risk and to grow. And that's really what we're trying to do. If you think of what impact investing is, it is investing to get a financial return as well as social or environmental impact. And one of the biggest social challenges across Africa is unemployment, is jobs for young people who are coming out of tertiary institutions and looking for jobs. And so at Impact Investing Ghana, one of the big goals that we have is financing SMEs who employ 90% plus of the population of many African countries. And if you look at what pools of patient capital, potentially patient capital we have in Africa, you quickly will get to pension funding. In Ghana, for example, we have $7 billion of pension assets under management. Across Africa, it's now about 700 billion pension assets under management. These are long-term savings. They are more patient capital. So at Impact Investing Ghana in 2021, we began to ask ourselves, how do we profitably unlock pension funding for the real economy, and providing a pension client with a better return, as well as development in the environment, so they retire into an environment where there's better healthcare, better infrastructure, better services, driven by the private sector, but also because we've increased taxation, because we have a bigger and more robust private sector. And so we've been working on that. It was a number of things. One was to structure financing vehicles at scale that could absorb pension capital. And so we're just at the first close of our first, it's a 75 million fund of funds. That is 70% Ghanaian pension funding and 30% international development and philanthropic funding. The international development funding is a blended vehicle and provides a little bit of risk mitigation for the pension funding. And this money is going to be invested into 10 financing vehicles that finance SMEs. They are private equity, venture capital, and private debt funds. And it's been structured in a way to provide a good return to the pension clients, but also to build the market. So for example, a good share of the portfolio is experienced fund managers who have Pan-African funds, a good track record. It's almost a guaranteed return. And then the other slice of the portfolio is emerging fund managers who are doing the smaller investment sizes that SMEs need. And they get, as part of a technical assistance facility, support to ensure that they can deliver a good return, but they can also build the market, and we can develop the next generation of innovative financing institutions that can deliver that patient capital that was talked about. So we're really excited to be at this milestone of a first close. And I'm sure as the conversation goes along, I can share a little bit more about the process that led to the success, because it wasn't that straightforward, and it never is if you're doing something that hasn't been done before.
Thank you very much, Amma. That's very insightful. And we will come back to you on some of the issues to get further insight. Our discussion here is global, okay? And we would like to know a little bit more, especially about the outlook for business and for finance in the rest of the world, especially focusing on Europe. And this is where Dr. Marcelo Cavallo comes in, especially in his global macroeconomics outlook and the global name recognition in that area. So, Marcelo, just if you could share with us the outlook for business and finance, especially in Europe, facing this geopolitical shifting, which of course is involves very much some of the economies in Europe. Please, if you could share your insights for us, especially with respect to the private sector. Thank you.
By inviting me to speak today, you're automatically inviting me to speak again next year. Let me explain why. Global macroeconomists like myself, they do two things. First, they come up with forecasts and scenarios and predictions, and then they have to show up later on to explain why those predictions went wrong. So that's a first disclaimer here. You have to invite me again next year. But joking aside, let me take a step back, look at the bigger picture in terms of the broader macroeconomic landscape, and let me make 3 points. I like number 3 because it's easier to remember. So point number 1, interest rates are higher for longer. Global interest rates are higher for longer. So let me give you very briefly a historical perspective here. In the 70s in the United States, inflation was very high. Paul Volcker came to the Fed, hike interest rates very high. Since then, inflation has been under control. Interest rates have been coming down over the last several decades. I mean, ups and downs, monetary policy cycles, but on average, rates have been coming down. Not just the policy interest rates, which is for the short term, but also if you look at the long end of the yield curve, I mean, yields for 10-year treasury bills, they have been coming down as well steadily for several reasons. That has changed. It changed around COVID a few years ago. Now, interest rates for the long end of the curve are increasing. And my point is that they are structurally going to be higher for many years to come, which changes the landscape for capital flows to emerging markets and financing for development. What's going on, I think, here is the following. Let me tell you a story. I worked for the IMF for a few years. You know what IMF stands for? It's not International Monetary Fund. IMF means it's mostly fiscal. I say that because when I was at the fund, you go to a country, you're a part of a mission. By the way, it feels very religious, right? It's a mission. Supposedly, IMF people defend the missionary position, I don't know. But anyway, my point is that you go to a mission to a country, and then you basically argue the problem here is fiscal. Put your fiscal house in order, right? To a country in Africa, let's say, you'll say, well, we'll hike interest, hike taxes, cut spending, and things will be better. So I say this because during the pandemic, even the IMF was saying, you know what? These are unprecedented times. Go ahead and spend like crazy. And countries did. Everyone did it. The problem is that defensible as fiscal expansion was back at the time, it outlived its usefulness. I mean, it's very easy to increase spending. It's very hard to bring it down. Few things are as permanent as a temporary increase in fiscal spending. So as a result, fiscal deficits are much larger now than before, and the public sector debt has jumped very high and is expected to continue to increase for many years to come. So this puts pressure, this crowds out potential flows to private sector, to emerging markets in particular. And this picture, I think, is aggravated by what's happened in terms of geopolitics. Let me explain. In the US in particular now, of course, there is less support to NATO. And that means that countries in Europe in particular have to spend more on defense. They, for many, many years, under the umbrella of security provisions by NATO under the US leadership, Europe could afford to invest in other things, didn't have to invest as much in the military and defense. Those days are over. So it's a traditional trade-off between guns and butter. You know, if you read the textbook economics, you see this analogy, right? In an economy, if you produce only two things, guns or butter, it's a trade-off. You produce one or the other. Well, Europe was able to produce lots of butter, meaning social safety scheme, because it didn't have to spend on defense. Those days are over. This means additional pressure on fiscal accounts in Europe, on top of other pressures that are going to be there anyway, namely aging and climate change. Both will require increase in spending for many years to come. So I tell you this story, Victor, to come to the conclusion that there will be pressures, fiscal pressures on the debt dynamics, and that will be putting pressure on the long end of the yield curve. There is a debt premium that is there, and it's here to stay. Along with that, I think there is also an inflation premium, because inflation is proving, particularly in the United States, to be a bit stickier than people thought. Inflation, the pandemic went high to 8%. It's easier to bring inflation down from 8 to 4% than to cut it by half again from 4 to 2. I mean, it's like toothpaste. It's easy at the beginning, but gets progressively harder towards the end, right? That's a picture of inflation. So there is an inflation premium. Inflation in the US in particular is clearly above the 2% target. The Fed is cutting rates in any way. There's a lot of pressure from the White House on the Fed, so this could erode the credentials of the Fed. This means an inflation premium for the yield curve as well. So to make a long story short, I think my point that rates are going to be higher for longer, point number one. If you allow me quickly to go point number two and point number three, point number two is that the geopolitical fragmentation is here to stay. This is more than just Trump. I think Trump is a consequence, is a reflection of much deeper, wider trends. And I think that has to do with the backlash against globalization, because for many years, globalization produced incredibly positive results for the global economy as a whole. Lower inflation, faster growth, free trade liberalization, and so on. However, the gains from globalization were not equally distributed. I mean, within each economy, each country, there are winners and losers. The economy as a whole gains, but within the economy, there are winners and losers. And we as a society, I don't think we're able to properly redistribute the gains from winners to losers. That's why you have this backlash against globalization. And it's not just in the US, it's not just Trump. I can see parallels in Europe as well, mega movements. Let's say, if you look at UK, you have Reform UK. If you look at France, you have the National Rally. If you look at Germany, you have the AfD parties, all tending towards, I mean, right-wing populism, that puts pressures on fiscal accounts as well, leads to more fragmentation, and I think this is here to stay. Since the post-Second World War, you had this US-led, rules-based global environment. These days are over. The US is clearly taking a step back from its leadership role across a range of multilateral institutions. I mean, think about the World Trade Organization, the World Health Organization, think about the United Nations more broadly, think about NATO. Even in regional terms, the so-called NAFTA agreement, the trade agreement between US, Mexico, and Canada, has been rewritten unilaterally by the United States. I mean, they call it now USMCA. Whenever I say that, it feels like I'm saying YMCA. So, but that's a different thing. Anyway, the US is unilaterally stepping back, and this is here to stay. And one clear example of that is tariffs. So tariffs in the United States is something that Trump sees as a policy hammer, so to speak. And look, if the only instrument you have in your hand is a hammer, everything looks like a nail. And that's what's happening, right? They use tariffs for everything. If you have an issue with illegal drugs coming to the United States, you impose tariffs on Canada. If you have a problem with immigration, impose tariffs on Mexico. If you have a problem with India importing oil from Russia, tariffs on India. If you have a problem with politics, if you have a problem with the friend of Trump in Brazil, former President Bolsonaro, going to jail for wrongdoing, well, impose tariffs on Brazil. So you use tariffs for everything. And the problem is also that tariffs are bad for growth, tariffs are bad for inflation, but they are being used to try to achieve completely different goals. It's actually not clear what Trump wants with those tariffs. In my mind, actually, he wants so many different things at the same time that in my mind, it feels like that song by the Spice Girls, Tell Me What You Want, What You Really, Really Want, because it's not clear. He wants to address the trade deficit, he wants to have more tax revenues, he wants to have more jobs, and those are conflicting goals. I mean, quick example here, if you are really successful in bringing firms to produce in the United States, so you promote jobs, by definition are not important anymore, you don't have tax revenues. So they're conflicting goals. My point, therefore, I think this is a structural shift in the global geopolitical landscape. It goes well beyond Trump. It's really global. It's here to stay. And in that environment, you see Europe in a very tricky scenario position, because you have now, rather than a globalized environment, you have fragmented environment with spheres of influence. I mean, in the Americas, of course, US still plays an important role. China in Asia is key, and Europe is trying to find its way. I mean, there's talk about strategic autonomy. I'm not sure how successful it is unless we have deeper integration in Europe. So this could be a silver lining for Europe if the crisis leads to more Europe. You have further integration, because Europe is an incomplete integration program, right? You had monetary integration with the euro, but on the fiscal front, on the labor front, on the rules, you still are far beyond what's really necessary for Europe to be able to stand up as a major power in global landscape. So that's my point number two. I'm taking longer than I should, but my point number two is global fragmentation is here to stay. Third point, more quickly, to end on a more positive note, I think there are challenges and opportunities as well, especially if I think about the outlook for climate change. So climate change, thinking about Africa especially, right, bringing it closer to the seminar here, it's interesting because, I mean, Africa is the region that least contributes to global emissions, right? Big producers of the polluters are the US and China, but it offers actually tremendous opportunities in terms of green energy. So that's one area in particular where I see challenges, of course, which are obvious. You can deny climate change, but it doesn't stop it from happening. But I see major opportunities in renewables, in Europe in general, but in Africa as well, especially. So to make a long story short, my three key messages are, first, interest rates are higher for longer. Second, global fragmentation is here to stay. Third, climate change brings challenges, but also opportunities, including for Africa. Thank you.
Thank you very much, Marcelo. You covered quite a lot of ground there. Your points are very clear, and you end up by pointing out the aspects of the future for energy transitions, especially for Africa. So this Fireside Chat has uncovered quite a lot of arguments, helped us to appraise where we are. We see signals for the end of aid. We think that creates the future for mobilizing private finance, especially through trade and investments. We see that that journey has started, as Amma eloquently pointed out, that we can actually have very fruitful impact investing, especially looking at examples in Africa. And with the Robert here pointing out the special role of microfinance, and being also a little bit futuristic in terms of where we are going. At this juncture, I'd like to give you an opportunity to come and weigh in the discussions in the limited time we have. I'll first take some questions, comments from the floor, and then I'll go online in case there are some of the comments coming online. So please mention your name, affiliation, and be very brief and to the point, the questions. Yeah, sure, yeah, Robert, go ahead, yeah.
Just reflecting a little bit of what Marcelo was saying is that, so the high interest rates are there to stay, you see, but isn't the problem for Africa even more problematic is that there's a lot of mispriced sovereign debt. What you see, I think, is that if you, despite all type of reforms, sovereign debt is overpriced. So it's a mispriced debt. So if you compare kind of credit ratings over countries, then somehow the African is mispriced debt, so that even the interest rates are higher. So kind of perceived idea about Africa is bad, instability. And I just want to have your view about it. Is this true or not?
I agree. That's a very good point. I think it's a mispriced risk because we do see in Africa, as it is the case in emerging markets in general, much more policy resilience than you would have thought. So I think when you look at emerging markets in general, Africa in particular, I think many people still have the views of 10, 20, 30 years ago. But things have changed in the meantime. On the macro front, I can point to a few developments in the positive direction. First, you have now much more flexible exchange rate arrangements, which is the way to go, right? Fixed rate arrangements, fixed exchange rate arrangements are a recipe for disaster. They don't last long. You try to artificially bring inflation down with fixed exchange rates. Eventually, it blows up with dire consequences. By the way, that's what Argentina is more or less trying to do today. Let's watch what happens there. But anyway, most emerging market economies have moved towards floating exchange rates, which is great. Second thing which is great is inflation targeting. Many countries, including Africa, now have an inflation targeting framework which promotes credibility of the central bank policies. And I mean, monetary policy is all about credibility. It's all about trust. It's all about confidence. And this is an arrangement that does promote that type of confidence. And it's a much better framework. And last but not least, very quickly, on the fiscal front as well, there is a search for fiscal anchors that help also to provide some transparency and visibility on the data dynamics going forward. So to make a long story short, there is a gap here in the perception versus reality. It's a mispriced risk. The reality is better than the perception.
Thank you both, Robert, that point of mispricing and observations, Marcelo. I attribute in my work the mispricing of capital and especially bonds by sovereigns due to climate risk. And the amount I calculated together with colleagues is $46 billion added to African debt over the last, say, 10 years. That's real mispricing on the yield curve. Okay, so let me come now and take the comments. Peter, I see your hand up first.
Thank you very much. I'm really enjoying this.
Peter Kwate, University of Ghana.
Peter Kwate, University of Ghana, yes. My first one goes to Robert. You spoke about the repayment, microfinance, suggesting the need for longer repayments instead of shorter repayments. You spoke about the size of the loan. But microfinance do not charge micro interest rate. The interest rate is a big problem for most borrowers. I didn't hear your comment about how that is a problem and what the solution should be. Then my last one to Our Lady online pension funds. Some of the pension funds in Ghana went through debt treatment during the debt exchange program. Did any of your funds go through that, and what are the implications on pensioners? Thank you.
Thank you. Let's take a couple of questions, and then we can come around and provide some answers. Please store the questions, Robert, Marcelo, and Amma. Yeah, go ahead.
Hi there, my name is Alexis Torrell. I'm from Development Unlocked. Just making a fairly sort of obvious point, a sort of a comment or observation to the panel, and that is about, ultimately, and I'm going to kind of distill it in a really simple term, just to stimulate some of the debate, that private sector investment need two things: one, certainty, and two, an appetite to take risks. And I feel that when we're talking about geopolitical fragmentation, the investment climate is currently really challenging because, investors, why would you put your hand in your pocket to invest in an enterprise or an initiative, knowing that, things may change politically, economically? We talk about, high interest rates. We talk about movements to the right, across Europe, and that seems to be gathering steam. So I feel that there's an awful lot of rhetoric within our sector about, the private sector used in its general terms of stepping up to fill the gap left by reduction of ODA. But I think the reality is really, really different, because I feel that, and particularly in the context of, the climate finance, climate change debate, why would private investors could commit that, given the sort of the backdrop of this challenging geopolitical environment? Thank you.
Thank you. Very critical question. Yes, Doug, and then Richard.
Thank you so much. I'm really enjoying this fireside chat. I think we're still going to get the fire drill, isn't it, at 10:30? So, one quick question is, I think when you started, Victor, was around the argument that the difference between the policy rate and the market rates, isn't it, and that the interest rate spread hasn't come down or has actually increased. And I think you were saying that was perhaps because of the geopolitical reasons, and I'm just wondering whether that's indeed the case. Whether we have seen the interest rate spread increasing. How can we? And is then the increase in spread, is that a real reflection of the real risks that are being faced, or is this something that could be reduced? And how can we then try and see and reduce it in the same way as there's this perception around mispricing of Eurobonds in Africa, and there are lots of arguments going on at the G20 and various levels about the cost of capital to try and reduce this. But what's happening at country level to reduce interest rate spread and competition?
Yeah. Thank you. Maybe we take Richard. Yeah.
Thanks, Richard Alexander from SOAS. This might lead into the other questions, or might not, but I was interested to hear Marcelo, towards the end of your comments, talk about the European Union and the way and the role it might play. We heard yesterday that the African Continental Free Trade Area has not been a great success, but of course Africa also has smaller, more regional organizations, ECOWAS, the East African Community, SADC to an extent, and I wondered what role you thought they might play in any of this.
Thank you, Richard. We have only 9 minutes, barely 9 minutes. Maybe I will give a quick, any questions pending? No, okay. I'll give but please be brief, Ahmad. Yeah, very brief, and to the point. Yeah.
Yeah, I'm speaking from the context of the Somali banking system and macrofinancing. In fact, we operate on Islamic, paradigms and completely different, what has been discussed now. And it is progressing very well. And some macrofinancing, companies or whatever you say, they transform it into banks. Just about 2 months ago, that was one of them, operating as a microfinance for, 6 years, and now they're a bank. Therefore, it's a different context about the interest when we talk about that. And it's the Islamic version I'm talking about. And Murabaha there, even in Ghana, Sadaqat, that's from Cardiff, my colleague, in Cardiff, operating that macrofinancing, which is Islamic in, Ghana as well. Therefore, that's a growing area, Islamic finance, particularly in Africa. Thank you.
Thank you. It's good you mentioned, Ahmad, that question of Islamic finance, especially where we have a couple of central banks driven, but not only in Africa. Pakistan is predominantly Islamic bank, central bank. Okay, this now, if you could just go straight to the point in the interest of time, because we have to go out to call the fire drill as well. Please give a chance to, I'll start with Amma, then Robert, then Marcelo, and I'll have the final word. How is that? Okay.
Right. So I'll go really quickly to Prof. Corte's question on the pension fund. So initially, pension funds were exempted from the domestic debt exchange program, and then they voluntarily participated. And like all investors, they got a hit, lower coupon rates, etc. But pension funds in our context are unique. They are growing exponentially because we have a growing population. So they are getting dry powder every month. Our pension industry has doubled every 5 years. And so we see that pressure that happened partially balanced by new contributions coming in from a liquidity point of view. And also those pension funds that were involved in innovative structures like the ones that we have brought to market actually did better because they had returns coming in through these other non-government channels. Currently, the pension trustees have invested over 80% of their assets into government bonds. And so they need to diversify. Just basic investment practice tells you need a diversified portfolio. And the domestic debt exchange actually accelerated that because now their boards are saying you need to experiment with other asset classes. But it's still a highly regulated industry. It's very conservative. And so products with features like what we brought to markets where you have de-risking, et cetera, makes it more likely that pensions will participate.
Thank you very much, Amma. Very interesting about the growth of pension funds in Africa. And I'm just thinking if you could draw a pension fund map of the world, you see where it is contracting, especially because of contracting population, and where it's expanding because of a growing population. Absolutely interesting. I come to you now, Robert, just 1 minute.
Yeah, and two very quick remarks. First on the, why do investors step in Africa, especially regarding climate issues? I think you're right. It's a very good question. But on the same time, you see a lot of things happening. I was, for instance, last week, I was in Kenya on the border with Tanzania, and there is a huge inflow, I couldn't believe it, of carbon credit. So big areas where Volkswagen actually was buying carbon credit. So asking people to change their grazing patterns, and they were offering carbon credit for it. So it was a huge, immense area where we're bringing that in. I'm not saying that's good. Carbon credit, there's a lot of problem with it. I see it, but there's a lot of money coming there. And why are investors doing that? It improves their image. They want to kind of show that they're CO2 neutral. So you fly with KLM and you buy something and that's going via carbon credit. So I think there's a huge potential there for Africa. And investors are doing that partly, maybe not for the best reason, but it improves their image. So that would be my short answer there. But I see the problem there. For the interest rate is another issue. I think that you see the microfinance market is extremely fragmented. You see microfinance organizations who are working like loan sharks, having very high interest rate, but you also have other microfinance organizations who have low interest rates. So it's very difficult to say. I think it's not right to say that all microfinance organizations raise high interest rate. No, they don't. Some do. A lot of others don't do. Your remark about the Islamic finance, I take that for granted. I did a lot of work myself on Islamic microfinance in Pakistan. It was working quite well. Well, I think that the main point here is in the microfinance kind of discussions, those microfinance proponents always said, this double bottom line. Microfinance institutions can do two things at the same time. They can reduce poverty and they can be financially self-sustainable. I think that's a myth. That's not possible. It's either one or two. If you want to reduce poverty without increasing interest rates, you need to be subsidized. So subsidies need to be come in. On the other angle, you have microfinance organizations who become like commercial banks. It's fine, but they can maybe become self-sustainable as well, and financially self-sustainable. Maybe because of focusing on a little bit other clients, they don't need to raise those extremely high interest rates. One final remark, and that's when I was just coming in yesterday here, and I told Hongbo already, it's a researcher, the worst thing can happen is that a paper of you is rejected. So yesterday there was a paper of me rejected, my top econ journal, which was precisely dealing with this interest rate problem. We thought we solved it by thinking about different type of contracts for microfinance organization. Fortunately, it was the first attempt, but I can send you the paper and there we sketch a theoretical solution for this problem.
Very interesting. It has to be one or the other, not both. Also interesting. Yes, Marcelo, final word, please. 1 minute. We are less than 1 minute.
On the issue of markets appreciating certainty, we live in an uncertain world. So global fragmentation, if anything, increases uncertainty. We should expect more volatility. We should expect more uncertainty. We should maybe be afraid of more conflict even. If you look at what's going on globally, if you see the resumption of nuclear testing, it's not a good sign. So I think it's a more uncertain world. Regarding appetite for risk, I heard yesterday comments about changing Basel III rules to increase appetite of banks towards risk. That's one route of changing the risk tolerance. Better still, I think, is to reduce risk itself, doing the reforms, do the homework in Africa, in emerging markets, to reduce risk itself. Regarding the European Union, the silver lining again is what Jean Monnet said, right? One of the founders of the European Union, that Europe will be forged in crisis. So this can be a wake call that leads to more Europe if you go towards the reforms like the Mario Draghi report suggested to really deepen the integration of Europe. But we're not quite there yet. Still unclear which way you go. And finally, regarding regional blocks, when you think about blocks, it matters the context. Are they set up in an outward-looking environment or not? Because they can be building blocks for a better future, or then they can be stumbling blocks for further integration. So when you have a block, you have trade creation and trade diversion. The critical point is to have a block which is moving towards outward-looking policies rather than inward-looking protectionism.
Thank you, Marcelo. And the one question that Dak raised about interest rate spreads, we know from evidence across developing countries that interest rate spreads are notoriously rigid downwards. They stick, and mainly because of the pricing of risk and the default rates by commercial banks, which are added on for loan loss provisions as incorporated in the next lending forward-looking. That's one big explanation in the literature we have. Let me thank you all for this active participation in the Fireside Chat. We promise we'll have the same Fireside Chat next year, Hong and Dak, and continue this fireside conversation. And thank you, Amma, virtually, and thank you all great people here who've been participating in this session. This is the close of the session. And back to Dak or to Angela. Thank you very much. Let's give a hand of applause to